Let's continue on to our market recap, our wrap the week segment. But I like to start with, the poll that we asked recently, and this is a little bit tongue in cheek, but this actually came. The question was, which of the Uniteds performs best over the next 3 months? And this is actually based off of a chart that used to be in the Fidelity chart room years ago. My mentor and one of my predecessors, Bill Doan, had created it called the Generals, and it was General Electric, General Motors, General Re, and a bunch of others, and there was all stocks named General. It was like a great sort of alternative index for the overall industry or overall economy. So in that vein, I asked, which of these four do you think is the best suited? United Airlines, United Parcel Service, United Healthcare, or Manchester United? Not surprisingly, only 6% of you went with Man U. And I'm a Tottenham Hotspur fan, so I will acknowledge that Man U certainly came in last in that one. It was actually a tie between UAL and UPS, and it's interesting. UPS is sort of a bellwether name, right? It's sort of the type of name that when that's doing well, when UPS is doing well, how bad can things be? Is sort of the way I've generally thought of it. UPS and FedEx obviously providing a lot of distribution for a lot of things. And we're certainly ordering now more than ever from home. It's interesting, UPS has had a pretty good run and stalled a bit just in the last couple of weeks, became extremely overbought, an RSI above 80, now pulling back out of the overbought condition. Looking at the chart here, you compare that with something like UAL, which really has been underperforming, but not by much. It's been sort of a sideways performer here for a little while, pulling back as most things have here in the last month or so. Very interesting to see UAL and some of the other airlines putting in a higher low, just above $50 a share. And that's a real pivot point for UAL. So I get the argument for both of those. Not a lot of love for United Healthcare. Whoops, that's not the right one. United UNH, I meant, sorry, UNH. And arguably out of those three, that's probably the best trend right now. So as a contrarian, I'm thinking United Healthcare might be the kicker there. Let's continue on with our wrap the week segment. Again, this is our opportunity to take a step back and look at how the markets have evolved from last Friday to this Friday. We're going to start with the weekly trajectory. We'll update just on today's markets and how Friday finished off, and then we'll look at the Mindful Investor Live chart list and go through as many of those as we can, just to sort of reset on the big picture environment going into the weekend. So overall, this is how things played out, and I don't have labels on here, sorry for that, but if you follow my mouse and my voice, I'll point you through where things are. So here's the S&P basically closing down about 0.4% for the week. So this is from last Friday to where we're at right now. Only two things underperformed the S&P. Small caps just a little bit lower, around down 0.5%. And then the biggest or the weakest out of all of them is crude oil here, down about 2.3%. Everything else outperformed the S&P this week by a very narrow margin. The dollar, which was only down about 0.3%, that's here in green, and we're using the UUP for that. Everything else was up on the week. Small caps, the NASDAQ 100 up 0.2%. In orange, we have emerging markets up 0.4%. Also up 0.4% is bond prices using the TLT. And then the biggest gainer out of that group of assets is gold, up almost 2%. It was very interesting talking with Katie Stockton yesterday, sort of a bullish take on gold, which I agree with. If you've been following what we've been doing on the show, we've talked about the rise in hard assets. We've talked about the benefits of gold sort of as a safe haven. And while it not always has been sort of a safe haven, if you have inflation concerns bubbling up, most likely gold would start to show some promise. And I think that's what we're seeing here. So interesting run in seeing that at the top of the list. Adding Bitcoin to the mix, we put that on here. That's here in blue, down 28%. Obviously continuing to weaken here. And overall, when you had that big move lower, we'll jump there very quickly before we continue on. Right, Bitcoin had a huge distribution down to 30,000, an immediate left turn up to 42,000. And I went on Bloomberg Television and elsewhere, was asked in a lot of media outlets about Bitcoin. And I know, looking at the volatility and the price moves, the severe price moves, has changed, 10,000 points in one day. That's a pretty significant move in any asset. Having said that, right back in distribution mode. And so it is fairly reasonable. This is what I would definitely characterize as a dead cat bounce. And if you look at the hourly chart, by the way, it makes a lot more sense because you can see how it fluctuates off of the lows and kind of comes back. It is absolutely expected, I would argue, after a huge down day like you saw on Wednesday to have a big reaction move back to the upside. That's why you call it a dead cat bounce. Even though overall the trend is still down, it's reasonable after a huge puking out, and I'm sorry, I don't have a better way. A huge distribution is probably a better way, but that's how I usually call it. After we've just dumped out all of the, all of the negativity comes out, not unreasonable that some people buy in on that big move down and expect a reversion back to the mean at the very least. We bounced back to that 42,000 level. I put a video on my own YouTube channel called Market Misbehavior a couple of days ago, focusing on Fibonacci retracements, focusing on these two shaded areas. And I'm not surprised to see we came back to 42,000, which is a Fibonacci level. That's also the highs from January. And that is where in the last 24 hours, we revert back to the downside and now just below 36,000. So if you missed that, maybe check out that video for a little more color on how to make sense of this range the Bitcoin is in. But I would see the movement lower in cryptocurrencies overall as the market in distribution mode and a very speculative part of the market in distribution mode. Let's focus just a little bit on today's action, and then we'll get to the long-term picture using the Mindful Investor live chart list. As I mentioned, the S&P essentially flat, just down a little bit below zero. The NASDAQ and the NASDAQ composite down about 0.5%, 6%. Mid caps and small caps are actually up a little bit, which is good to see. A little bounce higher in the afternoon session, and the VIX is nearing 20 again from above. Looking at some other asset classes, interest rates are actually a lot lower earlier, but came to finish strong around 163 on the 10-year bond. Prices up just a little bit, and the dollar up about 1/3% using the UUP today. Gold finished flat, and it was lower for much of the day, but actually rallied to close where it did. Silver was actually a little weaker. Energy overall okay, with oil prices up about 2.8%, and energy was about flat for the day using the XLE. Here's cryptocurrencies, and again, if you thought yesterday was an all clear signal, hopefully you got the caution in my voice that I think that is sort of the beginning of something deeper. And I think you heard Katie Stockton say a very similar thing. You don't have a huge distribution like you did 2 days ago, and then have the rally out of the lows like you did yesterday off of the 30,000 level, and not expect at least a retest of those lows, or at least another move down. Because what happens is it's a very behavioral, psychological thing. You have the huge distribution. Someone starts deciding, people run out of that group of buyers that are dumping it. All of a sudden that exhausts, and you have people coming in, sort of a value mentality, buying in and thinking you finally get Bitcoin at a half off sale and you can buy it for 30,000. That pushes the price right back up, but eventually it settles more into the long-term trend. And again, anyone that missed selling off on that first leg now all of a sudden can sell at a much better level when it goes from 30 up to 42,000. That puts it on the next leg lower. And this is that feedback loop that we talked about in the last couple of shows, right? The more things go down, the more that when it bounces up, people see that as an opportunity if they missed the first time that they can keep distributing. And that pattern will tend to happen until you run out of negativity, until you run out of people that are basically panicked. Once that anxiety wears off, when people have dumped it enough that enough people are willing to come in and buy it at the lows, that's when something bottoms out. I don't see that happening just yet on cryptocurrencies, including Bitcoin. Very quickly on the sector basis today, financial is the best sector of them all, up 1%. When I was screening earlier this week for stocks making new swing highs, I found a lot in the financial sector, and particular areas that surprised me a little bit. Some of the global banks, things like RBC, ticker RY up in Canada, Itaú, which is a Brazilian bank, Bradesco. These are stocks you may not be familiar with if you look just at U.S. stocks, but these are U.S. traded listings, U.S. traded names that are domiciled elsewhere. Maybe worth looking for a scan for financial stocks making new swing highs, because I think you'll find some interesting ones. At the bottom of the list, the growth trade, technology, consumer discretionary, communication services, 1, 2, 3, right from the bottom. So interesting, after where growth felt like it was showing signs of life, especially yesterday, you get another distribution there going into the weekend. So not a great setup for next week. Let's finish off looking at the Mindful Investor live chart list, and we'll hit as many of these charts as we can. So I update my market trend model every Friday at the close. Now that we've gotten there, it went literally back and forth between bullish and bearish. And as things settled off and as the S&P sagged down to close more on the weaker side today, it was just enough to trigger the short-term indicator and the medium-term indicator on my model to turn negative on both of them. Just slightly negative on both, but a confirmed negative on both. And so, from my opinion, that means you're in caution mode going into next week until you see a reversion higher, especially on this medium-term model, which is more of my main risk-on versus risk-off model for stocks. It's telling me to be more cautious and think more about defense, think more about risk tolerance, lines in the sand at which you would agree to exit positions, and less about looking for the next great home run that you can swing at. So interesting to see after chopping around for quite a bit, it turned slightly negative. Next week is going to be interesting going to the daily chart because it's a holiday week, right? It's not a shortened week, but it's the week leading up to the shorter Memorial Day holiday. And usually that week leading up to the holiday, especially going into Thursday and Friday, more often than not is usually sort of a flat to up period. That's usually lighter volume, but usually you trade higher going into a longer weekend. So it'll be interesting how that jives with some of the distribution that we're seeing so far today. Now, to be honest with you, when I'm looking at a lot of individual charts, I'm not struggling to find charts that look pretty good. I'm not struggling to find charts like Facebook that are holding up just fine. And the chart of the S&P is a perfect example of that. I'm seeing signs of distribution. I'm seeing signs of negativity. I'm seeing signs that concern me about the coming months for stocks, but what I'm not seeing is an index that's able to break down more than 5% or so. And if you look, the S&P finding support at its 50-day moving average, finding support at trend line support going back here to last October is all very positive. The concern I have for stocks is on the chart of the S&P, the chart of Apple, the chart of Facebook, the chart of some semiconductors, the chart of a lot of names. We've bounced off of a key support level. And a chart like Apple or a chart like the S&P in a day or two can look very, very negative. Think of what would happen next week if we break down through that trend line support, break down through the 50-day and follow through. All of a sudden, this looks like a market much more in distribution mode. And I think you could see very much a capitulation, an acceleration of selling enter in if people, sort of a forced selling sort of mentality. If we start breaking support levels and people feel that this could be a longer, more drawn out in price and or time sort of a pullback. But having said that, first thing needs to happen, you have to break support. So I would argue now is a perfect time, if you've not done so already, to review things that you are holding and focus on some of those lines in the sand. For the S&P, I think it's very clear around 4050 to 4100. That's trend line support, the 50-day moving average. Also now the swing low from May. We hold above 4050. Overall, the trend is not that bad. We start breaking that next week, I would be concerned. Breadth picture overall has remained fairly constructive. You're seeing some of these downturn this week, but the market's turning down as well. So it's not really a bearish divergence. We have the market going higher and the breadth is weakening. The breadth is sort of mirroring the overall market. It's not breaking down a lot yet. All of these are still above their 50-day moving averages at this point. So overall, remaining constructive. You have seen an evaporation of new highs. We talked about an expansion of new highs as being a very bullish configuration. That's what we had through the second week in May. We now have more of an evaporation of new highs. We have very few stocks making new highs. That shows you most things have sort of pulled back in the last week or two, much like the S&P has. We're sort of sitting a little bit below all-time highs, but again, we're just a little bit below all-time highs. So let's caution the negativity. Where there is some, I think that we'll have to leave it here, but this is one chart I'll certainly be following, and I'd encourage you to do the same on breadth, is the percent of stocks above their 50-day moving average. It pulled back from around 92% down to around 71%. It might be a little bit lower as we process that through today's close, but overall sitting right around 70%. And that's not bad. What's interesting is in the January pullback, where you pulled back about the same amount, we got down to around 40%, 45% of the S&P above their 50-day. This is as the S&P was testing its own. You can see this time, the S&P tested its 50-day, but only 70%, or actually 70% remain above. So there's a 20% difference between those two, 20 to 30% difference. So that shows you that the downturn has not been as widespread as it was back in January or in early March as well. This indicator holding 50% tends to be a really good differentiator between the actionable, buyable pullback like you saw in June of 2020, like you saw in January of 2021, and more of the drawn out, more painful pullbacks like you had in September of 2020, which ended up taking a couple months, August of 19, where you saw a 2-month period before we resolved new highs. So that is an indicator as we start to think about potential pullback mode that I will be watching.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.